Welcome back to the deep dive. Today, we are stripping down the engine of the American economy, really.
That's a good way to put it.
We're looking at Union Pacific's full year and fourth quarter results for 2025. And honestly, if you just read the headlines, you might think we're living in some kind of boom time.
You really would.
But if you actually read the report, like really get into the fine print, it tells a much more, I don't know, complicated, almost contradictory story.
It's a fascinating document. It is rare to see a company post what they're calling a record-breaking year in terms of profit, while simultaneously warning everyone about a, quote, muted economic forecast.
That's the tension. That's exactly what I want to explore today. We have this legacy railroad, a company that's been around since what, Abraham Lincoln?
Yep, since the very beginning.
Squeezing record profits out of a flat economy. And at the same time, they are trying to pull off maybe the most ambitious, riskiest maneuver in modern transportation history.
A merger with Norfolk Southern.
Creating the first transcontinental railroad.
It's the elephant in the room. And you could argue it's the only thing that really matters for the next decade of logistics in this country.
We're going to get to that merger and specifically the safe harbor warning labels they attach to it because they are wild.
Oh, they are.
But first, we have to look at the scoreboard. We're working from the January 27, 2026 earnings release. So set the scene for us. What are the big numbers that have Wall Street cheering?
Okay, so the headline is really efficiency driving profitability. For the full year 2025, Union Pacific posted net income of $7.1 billion.
$7.1 billion.
Which is a 6% jump over 2024. And if you look at earnings per share, the EPS, it's even better. 11.98 per share, that's up 8%.
Okay, $7.1 billion is a lot of money. But I want to pause on the sort of quality of that number. I noticed the report relies heavily on adjusted figures. And whenever I see adjusted in a financial report, my skepticism radar just goes off. It usually means ignore the bad stuff. So what are they adjusting out here?
It's a really fair question.
Yeah.
And usually, you're right, companies use adjustments to hide operational failures. Here, it's a bit of a mix.
Okay.
In the fourth quarter, they had this massive one-time gain of $294 million from selling off some industrial parkland.
Right, so that's basically selling the furniture to pay the rent. That's not railroading.
Exactly. It inflates the raw numbers. So to be honest about their core performance, they stripped that out. But on the negative side, they also took out $30 million in cost directly related to the Norfolk Southern merger.
Lawyers, bankers, consultants.
All of that. So the adjusted number is actually trying to give you a clean view of the core railroad business. How much money did they make just moving freight?
And the answer is?
Even when you strip all that out, the core business performance was still very strong.
The metric everyone in this industry obsesses over is the operating ratio, the OR.
Right.
For those listening who don't spend their lives looking at rail spreadsheets, this is just operating expenses divided by revenue. Lower is better. Union Pacific came in at 59.8% for the full year.
Which is a huge psychological barrier, getting under 60%.
It is, but let me push back on that a little. In the era of precision-scheduled railroading PSR, where they've cut everything to the bone, isn't 59.8% just par for the course? I feel like a few years ago, the big goal was to get to 55%. Is slipping just under 60% actually that impressive in 2025?
That's a very nuanced point. You're right that let's call it the gold rush of PSR promised mid-50s.
Yeah.
But we've kind of hit a point of diminishing returns and inflation has hit labor and materials hard. So maintaining a sub-60 OR in this kind of inflationary environment is actually a pretty heavy lift.
Okay.
However, there is a crack in the armor. In Q4 specifically, the OR slipped back up to 60.5%.
And that's because volume dropped, right?
Precisely. Railroading is a high fixed cost game. The tracks cost the same to maintain whether you run one train or 100. So when your volumes dip like they did in Q4, that efficiency ratio naturally gets worse.
This leads us perfectly into the how, because revenue is basically flat up only 1% for the year. So if you're selling the same amount of product but making 8% more profit per share, you aren't growing your way to success. You're cutting your way there. Or optimizing, to use their polite term.
Optimizing is absolutely the word of the day. If you look at the operating results, they've managed to turn the entire network into a conveyor belt.
Okay.
The key metric here is freight car velocity. In 2025, they hit 225 daily miles per car. That's an 8% increase.
225 miles a day. That doesn't sound like a lot for a vehicle, but for a rail car that usually spends half its life just sitting in a yard, that's That's significant.
It's huge, and it's paired with an 8% reduction in terminal dwell. Dwell is the enemy of profit.
Right.
It's the time a car sits waiting to be switched. They got it down to 20.9 hours.
So assets are moving faster, but here's the stat that just stopped me in my tracks. Train length. The average train length in Q4 was 9,729 feet.
Nearly 2 miles.
2 miles long. I'm just trying to wrap my head around the physics of that. We're talking about a single crew, a few locomotives, pulling a 2-mile-long snake of heavy steel.
It's a 3% increase over last year. And this is the secret sauce of their profitability.
That's so.
Well, if you can make the train 3% longer, you effectively delete 3% of the train starts, 3% of the crew costs, and you reduce congestion on the whole network. You're just moving more tonnage with fewer movements.
But at what cost? I mean, we've all seen what happens when these massive trains run into trouble. The physics of braking and managing the slack action on a 2-mile train are exponentially harder than on a 1-mile train.
Oh, for sure.
Are they pushing the envelope of safety here?
That is the perennial debate. The labor unions will tell you it's incredibly dangerous. But Union Pacific's report is very aggressive in countering that narrative. CEO Jim Veda calls 2025 their best ever year for safety.
Best ever.
Yeah, they highlight improvements in both personal injury rates and derailment rates.
So the data, their data anyway, says they're safer even as the trains get longer.
According to their internal reporting, yes. They would argue that technology, better wayside detectors, better predictive maintenance, is allowing them to scale up the size without scaling up the risk. Whether you trust that long-term is a different question, but the 2025 numbers, they support their case.
All right, let's pivot to the health check aspect. Because railroads haul everything, they are basically a rolling GDP report. When we look at the commodity breakdown, what is the American economy actually buying right now?
It's a real split-screen economy.
Yeah.
You have very clear winners and very clear losers. And the biggest winner. It was a shock to me, honestly.
I was trying to guess this before we started. In a muted economy, usually steeples hold up. So, grain, food.
You'd think so.
No.
But the superstar was coal and renewables.
Coal. Really? I thought we were phasing that out.
Well, the category combines them, but let's be real. Wind turbine blades aren't driving a 24% increase in volume.
That's coal.
But 24% increase.
Revenue ton miles were up 24%. It's massive.
Wow. What does that tell us? It tells us that energy demand is resilient and maybe that the green transition is hitting some economic speed bumps. When push comes to shove and natural gas prices fluctuate, utilities burn coal.
So it's still the base load.
It generated nearly $1.8 billion in revenue for them. It's the cash cow that refuses to die.
Okay, so we're burning coal. What else is moving?
Industrial products. Chemicals and plastics were up 7%. Fertilizer up 6%. This suggests that the industrial base, the factories making the raw materials for other stuff, is actually chugging along quite well.
So the industrial side is healthy, but you mentioned losers.
Yeah, the loser is the consumer.
Huh?
And the evidence is right there in the intermodal numbers.
Intermodal, that's the shipping containers, the stuff that ends up at the mall or on your porch from Amazon.
Correct. Intermodal revenue was down 2% for the year. But the alarming number is Q4 volume, down 12%.
Down 12% in the fourth quarter. That's Christmas. That's supposed to be peak season.
Exactly. For volume to drop double digits during the holidays is a flashing red light. It tells us that retailers, the Targets, Walmarts of the world, were not restocking.
They were just sitting on inventory.
Either they were sitting on too much inventory, or they're predicting a very weak consumer in early 2026.
That lines up with this whole K-shaped recovery people talk about. If you're in energy or industrial chemicals, things look great. If you're selling sneakers or electronics, things are drying up.
And forest products, lumber was down 3%. That tracks with the housing market stagnation. So you have a very clear picture. Industrial strength, consumer weakness.
Which makes the timing of this next topic even more dramatic. Right in the middle of this weird split economy, Union Pacific is trying to execute a merger that changes the entire map of North America.
The transcontinental ambition.
Let's talk about it, the acquisition of Norfolk Southern.
Yep.
We've touched on the cost, but I want to dive into the safe harbor section of this report. Usually this is just boilerplate legal text.
Past performance is not indicative of future results, blah, blah, blah.
Right, but this time, it reads like a thriller novel.
It really does. It's a laundry list of existential threats. They aren't just worried about interest rates. They are explicitly listing the Eastern Ohio incident as a major risk factor.
The Eastern Ohio incident. That is a very, very polite way of saying the East Palestine disaster.
The derailment that released a toxic chemical plume and forced an evacuation. Yeah.
It's a massive liability. And by acquiring Norfolk Southern, Union Pacific is essentially importing that entire liability onto its own books.
The report lists environmental remediation obligations and potential new regulations as specific risks. They're not hiding from it.
This is what I just don't get. Union Pacific spent a year getting their own house in order, record safety, record velocity. Why would they want to buy a company that is currently synonymous with railroad disaster?
It's the allure of the map. Creating the first true transcontinental railroad, linking the Atlantic to the Pacific, it gives them pricing power and logistical dominance that no efficiency program can ever match.
So they think they can fix it.
They're betting that they can fix Norfolk Southern's problems with their Union Pacific playbook.
But the regulators have to sign off on this, the Surface Transportation Board, the STB. And the report notes that approvals might come with conditions that adversely affect the combined company.
That's the poison pill risk. The SEB could say, sure, you can merge, but you have to sell off 20% of your track to a competitor.
Or you have to cap your rates for 5 years.
Exactly. If the conditions are too harsh, the merger ends up destroying value instead of creating it.
And let's not forget the pure operational risk. Merging two of these giant railroads is notoriously difficult.
Oh, that's a nightmare.
Computer systems don't talk to each other. Union agreements, conflict. History is just littered with rail mergers that resulted in 2 years of total gridlock.
The meltdown risk is real. And remember, they're trying to do this while running 9,700-foot trains.
Right.
If you have a system meltdown with trains that long, you don't just have delays. You have a paralyzed national network.
So looking ahead to 2026, they've given us their outlook. They see a muted economy. They have this massive merger distraction. What's their strategy to keep growing?
This is the part that might annoy the average listener. Their strategy, and I'm quoting here, is pricing dollars in excess of inflation dollars.
Translate that for me.
It means they plan to raise their prices faster than their own costs go up.
So even though the economy is muted, meaning demand is soft, they're just going to hike prices.
That is the power of duopoly. Or, if this merger goes through, a near monopoly on certain routes, they are signaling to Wall Street that they have the leverage to charge more, regardless of what the economy is doing.
That is a tough pill to swallow for shippers. And at the end of the day, for consumers, it basically says inflation is going to stick around because we have the power to make it stick.
It's a flex. They're projecting mid-single-digit earnings growth, largely driven by that pricing power and continued share buybacks. They're also investing $3.3 billion back into the business, so they aren't starving the beast, but they're certainly planning to extract maximum value from it.
So let's synthesize all of this.
Yep.
We have a company that is, operationally tighter than it has been in years. They've mastered the physics of moving massive amounts of freight efficiently.
Yep.
But the cargo they're moving is shifting toward old school energy and away from consumer goods. And looming over everything is this massive high stakes gamble on Norfolk Southern.
That's the summary. It's a company at the absolute peak of its operational game, deciding to roll the dice on a transformative but incredibly messy expansion.
They're betting their efficiency engine is strong enough to handle it.
Strong enough to handle the indigestion of a massive merger.
And that leads me to the big question I want to leave with you today. We often talk about economies of scale, that bigger is better. But in this case, Union Pacific is taking a network that is running at best ever safety and speed, and mixing it with a network that recently suffered a catastrophic failure.
It's a complete culture clash.
Exactly. So the question is Union Pacific going to successfully export its safety and efficiency culture to the East Coast? Or are they importing risk and complexity into a system that is already stretched to the absolute limit? Because if a 2-mile-long train derails because of integration issues, the muted economy will be the least of their problems.
That is the multi-billion-dollar question. And the answer is going to play out on the tracks in 2026.
You'll be watching. Thanks for joining us on The Deep Dive.
Thanks for listening.